Welcome back to smarthelping.com. I've got a new template here, and this is a SaaS, enterprise SaaS build. I've done a lot of SaaS models in the past. Over the years, I've got, as you can see here, about 9, 10 uh, that are SaaS or SaaS-like. But out of all of these, I've never done one where you have a variable for the contract length of a customer. So what that means is, let's say you have a pricing tier and you want to say these customers sign up and their contract that they sign up for is for 9 months, and the value of that contract is, let's say, $500,000 or whatever it might be. So I've never done that variable in a template. I've done that in a few different private jobs, but I've never tried to take that logic and put it into a template. So this is uh, me now trying to do that here. So what I'm going to do is go through each tab, explain all the assumptions, and you'll know exactly how everything works, is tied together. Um, you should note that I'm not a financial advisor. This is not financial advice, so use at your own risk. Also, all the assumptions are arbitrary that are in there right now. You would use this for the logic, and you'd have to research and put in your own assumptions that make sense for whatever business you're trying to model. So the index page just shows all the tabs and in a just a summary, quick summary of what's in them. You've got some definitions here. The control tab is pretty standard. This is what I do in all my templates. Just you're setting the start year, exit month if applicable, an exit multiple, and this one's using a multiple of this trailing 12-month sales. See if I put in a date here, it'll pop in, but I just have NA for now. Uh, Cash sources, so if you're raising any debt from like the bank or investors here, and how much you're giving the investors, and then any remaining cash that's needed would fall to the owners uh, or whoever's starting the business. If you had no investors or debt and you're just putting all your money into it, just the default here would be the minimum monthly cash position. Then it shows debt and equity here, which will vary as you change the assumptions. But let's get into the first revenue assumptions tab. This is super like really complex logic, but I've tried to make it simple for the inputs for users. And so every tier works in the same way, exactly in the same way, but it has obviously different inputs. So here they are, and you can define the start month. So when this tier of customers is turned on, the average contract length. So let's say here we got it at 6 months. The starting organic customer count is one. And so what I did here is I made two different ways to grow customers. One is organically, so you can say on February you're starting with one customer added, and you're gonna increase the amount you're adding by this amount each month in each year. So in year one, it's saying you start at one, and then month two you add 0.5% more, like one times 0.5% plus one. So a little bit more every month, and this is organic, so it's like word of mouth, uh, organic search from a website, referrals, all that kind of thing. And usually that grows kind of exponentially, so that's why I did a monthly compounding growth rate and based on some starting number. And don't be afraid of decimals. Decimals are completely fine. It's okay if it says, oh, you've got 3.5 customers. In a financial forecast, you're never going to know the perfect, it's never going to be perfect, and who knows what actually happens in real life. But in a forecast, if you had something that said 3.5 customers, it means in that month you might have three, you might have four. So the best way to estimate that is you go 3.5, and then whatever the contract value and all the logic is for how much you're getting will just be somewhere in between having three and four. That's actually the most accurate way to do these forecasts. I know it's not a whole number, but it's completely fine in a forecast to have decimals for your customer count for the purpose of trying to project uh, revenues. It's actually the most accurate way to do it. Okay, so organic growth, then you can do a percentage improvement on how much your the increase is that you're adding each month. So you start at 0.5%. And let me just be real clear here. That means that like month one you're at 1, month 2 you're now adding 1, and let's just make it a bigger number. If it was 100, in month 2 you're now adding 100.5. In month 3 you're now adding 101. So this percentage is just defining how much your monthly added users is growing by. So if we started at 1, you can see here in the monthly at the top, organic growth here is starting at 1. And if we go show some more decimals, you can see it better. See 1, 1.005, 1.01, 1.015. So the amount you're adding is going up each month based on those percentages. And again, these are things you have to research in what you think is reasonable that your business can do, which would be different for everybody. But I try to do a lot of percentage improvement uh, on the assumptions um, because that kind of gives more context around why you're increasing things and how they're increasing. So that's the first way you're adding customers. The second way you're adding customers is through ad spend. And that's saying, this is the monthly amount of ad spend. This is your cost per acquisition. Let's just do a round number so it's easier to explain. Let's say your cost is 50,000. Well, in that case, you're now adding 2 customers per month in year 1. And then in year 2, we're saying the cost per acquisition has improved to 47,000, which means your conversions are better and on your ad spend. That's essentially what this is saying. This is what this improvement percentage is doing. So now you spend 100,000, you had 2.1 per month. Year 3, 2.2, so it's going up. So that's the second way you're adding customers in this logic here. So you see the ad spend customers added is right below the organic, and it's going to be the same for every month, and then it'll change each year as you adjust those assumptions. Um, so 2 different ways to gain customers. Then you have, how much are these people paying? How much are the customers paying over the life of their contract? So here we're saying they're 6 month contracts. During that time, they're going to pay $50,000. So we get a monthly value of essentially the contract value divided by the length of the contract. And worse, you might get all this money up front, but the main way that revenue is usually recognized in these situations is just evenly over the length of the contract. So that's how it's going to show up in the P&L here. And then you have a percentage improvement on the contract value. So this is saying like everybody in year 1 that signed up is going to pay $50,000 every 6 months. Everybody joining in year 2 is going to pay 51,500 and for 6 months. Now here's where I really feel like this model has gone above and beyond and really put in some assumptions that are not in many models. The percentage increase in contract value at renewal. So this says this is basically your expansion MRR or expansion revenue. So what this is saying is everybody who joined in year 1 is paying $50,000 for 6 months. On month 7, you have some retention rate, which is defined below here. So we're saying your retention rate is 90%. So in year 7, 90% of these initial people that signed up will still be there. And what this logic is going to do is it's going to still reference the 50,000 they're paying, but it's going to increase it by this percentage on every renewal. So renewal 1, which would be in month 7, is going to be they're going to be paying 1% more. Now, if this doesn't fit your model, if you don't have ways that a customer can increase their contract value from what they started at, then all you would do is just hit 0% here, and that's completely fine. But having this ability to model expansion revenue in this way with these variables, I think is super valuable. And not a lot of people know how to build this logic in a dynamic way, but is really valuable to be able to show that if it's relevant for your business model. And the way that's done is actually for you can see on the validation tab, each tier has its own logic structure where you're counting renewals. This multiple here is what the 1% is based on and is compounding. So it's saying if they renew, a second, a third, a fourth time, you're actually growing by 1%. Let's say it's 10%, just so you can see a bigger number on the validation. So you can see you start at 1, then everybody who renews the first time is now at 1.1 multiple. Everybody who renews the second time is at 1.2. And this multiple is applied to this contract value every time. So that's how that's what I'm referencing in order to show an increase in the contract value of everybody that joined in year 1 at 50,000. Now everybody who joined in year 2 will have the same, they're still referencing this 1%, but now their starting value is 51,005 instead of 50,000. And this can work, if the starting contract value never changes, you can obviously put 0% here, and that's completely fine as well. And it'd just be the same numbers. But I've made it dynamic so you can actually have a different starting contract value in each of the 5 years, and each of those has the ability to grow in value at each renewal period. And that's based on the retention. We have an improvement in retention, which this would go up. Improvement would mean it's going higher. And this number can never go over 100%. So if you put your starting retention at some percentage and then have it going up over 100%, that will be inaccurate. You can't retain more than 100% of what you started with. It's just not possible with it because this is based on cohorts, and um, yeah, that can't be over 100%. So each tier has all of this logic built into it, and you can change these numbers, and everything changes. To show you a little bit of the magic of what's happening here. So here's the matrix that I developed this on my own as a way to show dynamically rec- recurring customers based on some retention rate and how much is left over time. So to do it, I have the first matrix, which is it's counting the amount of total customer. Oh, and we are assuming here, I am assuming that the contract value and the churn rate is the same for customers that joined organically versus through ad spend. So those are all assumed to have the same kind of performance. There's no differentiation there. So we've got the total customers that joined each month here in the top matrix. Then we have the age. So this is going to count when they started joining. It's going to start a counter, and it's going to count and know what month it is in the life of that um, cohort. And this is very important to know because if you look at our validation tab, you can see um, the retention is going to be based on what month it is in the life of a given customer cohort to know how much of that cohort is left at any given point. So that's what's going on here. And you actually have, since we have different retention rates for customers in each year, or the ability to do that, we have to show 5 different retentions possibilities for the 5 years, and then based on the months that they've been there, this is how many customers are left. So this logic is super difficult to figure out, but um, we've nailed it here. This is really nice. Then we have the year joined, which is also important to figure out what year um, should be referenced when calculating revenues and churn and everything else. Then we have percentage cohort remains. So this is the first area where you can kind of see, okay, so tier 1 customers, I think I set it for 6 months. So you can see, look, there's 3 customers that joined in month 1 for these was February because we have this revenue stream starting in February. So you can see here 3, 3, 3, 3, 3, 3. So 6 months, and then look at what happens month 7. You have the contract is up, so now there's less from the original 3 that joined. You now have 2.7 of those customers left. And then you go another 6 months, and then you have 2.4, and another 6 months, 2.1, and so on, all the way down to eventually 0. And what that means is these customers, if churn exists, at some point they're going to be gone. You don't know when, but you can put the percentages around it with the retention rate and know, okay, if it's 90%, okay, in 10 renewals, then this should be at 0. So you evenly reduce the amount of customers that exist over those 10 periods. And here we're saying one period is actually 6 months. And you could put this, let's say I wanted this to be 7 months, and retention rate of, let's keep it at, we can put 80%. So in theory, 80%, that means you're losing 20% each time. So that's 5 periods. So really 35, if you times that by the contract length of 7 months, in 35 months, we should be to 0. So if we go to our matrix here, you can see it's still 3, 3, 3, 3, 3, 3. But now we've added 7 months. So now there's a 7th month where you still have them all. And then month 8, you've now got the retention kicking in. And you see this going all the way down, down, and then you're at 0. And if you can see if I highlight this, it should be, yeah, 35. And then, so that's basically saying at month 36, you now have a renewal that's 0% we're on tier 1 on the first uh, year 1 cohort and on the first month. So you can see how that's going. 1, 2, 3, 4, and on the 5th renewal, you're now at 0% at 36 months. So that's how this is super, like, this is the only way to do this logic. I feel like that's in a dynamic way, and we've done it here. Then you've got, renewal counts, which is also important to know. If you're going to do, this is the only way to do expansion revenue in this way, where you need to know when a renewal is happening to know that that triggers your increase in how much the average account is paying. So that's all dynamic. Then we have the value earned, which is going to take them out into account. So this is like in month 2 cohort. These are all these customers. These are what they're paying. You can see after 7 months, it's a little bit less. They are paying more, but it's less people. If we put the expansion high enough, like let's say it was 50%, that number probably goes up higher. Yeah, so it goes from 21,000 to 25,000. So that would essentially be negative churn here because you're getting more revenue from the same cohort, even though you've lost customers, but the customers that stayed have paid more. So that's like why this, you don't see this much in models, but it's super, super important uh, to think about when you're trying to set up this kind of enterprise SaaS organization. So then we calculate churn based on referencing the customers that are staying versus not above. And then you have churn dollar amount as well. And that's it. So I basically just explained to you how tier 1 works. Tier 2 and 3 work exactly the same way, just different numbers, different references. And yeah, this is the biggest value that this model has to offer is the revenue logic. But we can move on. The next tab is CS, which is customer service. And here we're defining the amount of customer support and other support people that are needed per active customer. So this is ratio, and then you can define their salaries here, and that's going to all flow through to the model. And I'm in customer support, we're putting in cost of goods sold. And you can see the head counts of customer support, and then their resulting revenues, or not revenues, or resulting salaries are popping in here. um, in these 3 rows. Now, again, decimals are completely fine. Same same reasoning as having decimals for customers. It's okay. It just means you think you're going to be somewhere around that number. Like here at 2.5, we might have 2, we may have 3. The best way to represent that mathematically and as a value is to do 2.5, and then it's going to be multiplied by whatever the annual salary is, uh, divided by 12 to get a monthly figure. Um, so you can do improvements as well, and that basically means you start here at needing 2 customer support people for every 1 customer, and then that's saying this value here below is saying how many customers a given rep can handle. Well, if you need 2 per person, then really 1 person can only handle 0.5. And the idea is that you can improve that over time. You can see here if we improve it by 10% over time, eventually there's only 1.31 customer support are needed per customer. And now you're saying a customer can handle 0.76 of 1 person instead of 0.5 at the beginning. And that logic is all the exact same for tier 2 and tier 3. Uh, the other dynamic headcount is sales. So this is saying how many customers are added per month drives the amount of sales people that you need. And here, again, if we put this at 1, well, obviously, if you need 1 person per customer, 1 salesperson per 1 customer, then it's just a 1-to-1 ratio. But if it was 3 here, we're saying like other sales support, you need 3 per customer. Well, now 1 customer, you only handle a third of a person, and you try to improve that. You can also put this below 1. Let's say I put it at 0.1. What that means is you only need 1 other sales support per 10 new customers added. So I mean, that might give you a better idea of what is going on here. Or for 0.5, it means each customer support person can handle 2 new customers added for the month, for each sales support person. And then you got the revenues and the improvement in the efficiency essentially of the salesperson. Same exact thing for tier 2 and 3. And these are all dynamically referenced in the model. Salespeople are down in sales and marketing right here, and that logic for their headcounts is here. So so now based on all those matrix tabs, we can get a tier 1, 2, and 3 running count of customers, how many were added, how many churned, and any monthly value, and then how much revenue that's generating each month based on those customers. I also consolidated it so you can see all customers at once. And then here's the revenues and all revenue, all churn, all churn dollar as a percentage. So again, this here, if this actually could be negative, and if it is negative, it basically means more revenue is happening from existing customers that outweighs the revenue loss from those that lost. So let's try and make that happen real quick just to see. So let's say this is again at like 50%. I'll put it at that for all 3 tiers. I think that should give us a negative. Let's see. We're seeing a 0. Let's go back to the matrix. So if we look at churn of dollars, so it's going up. Let's see if I have a logic thing here that says if it's negative, don't count it maybe or something. Let's see. Churn dollar. Yes, if it's less than 0, then 0. So actually, we don't need that to say that. We can say, I know why I did that because to outweigh the first month. So like if you go from 0 to 21,000, that doesn't mean you actually added 20. That doesn't mean anything to churn. It's just the start of the customer cohort for each one. Okay, so that's that makes sense of why I did that. Let's see. I don't know if there's a better way if we want to see that. We could actually say better than this. We could say if we can reference the life, so the life of the cohort. So we can say if the life of the cohort is less than 1, then it should be, the number here should be 0. So if the age is less than 1, then 0. Let me try that real quick. Let's see. Does that work? Yes. Perfect. Let's see. Do we need to go one offset it? Yeah, we need to offset at 1. So if it's less than 2, because month 1 we don't want, because we know month 1's always going to be a negative number because you go from 0 to having customers. So less than 2 would work there. There we go. And then we got the minus. So this minus here is your negative churn, which everybody, in SaaS, that's a really, really important metric to understand. And okay, now we've got it. So, and we can change that in all of the tabs. So 501, we'll go to matrix 2. Doing this on the fly here, but it's okay. So here it's positive because the actual loss is still greater than what's gained from the original and for this cohort based on the assumptions. Yes, so it's still going down, which is it all. So the big thing with negative churn that you need to understand is if your actual customers are not leaving that often, so if your retention rate's really high, then the amount of expansion revenue that you need from your existing customers, it doesn't take a whole lot to get to negative churn. But if your churn is really high, then the amount you're going to need from your existing customers goes up. So there's a relationship there um, to be aware of. Okay, this looks good. Let's go to matrix 3, 501. Oh, I lost the paste. Here we go. Yeah, and this is, I mean, it's sometimes hard to conceptualize, but after you just study it for a little bit, negative churn is that you see why it's so, it means a lot. If a SaaS business has negative churn, it means a lot. And some people call it almost like a savings account for a business. But let's go now to the visuals because this shows, I just want to see it on the chart. Yeah, look at this. So your average monthly churn, negative churn in action. You can see it right here. So you can see the churn and it's negative. If it was positive, it means you're losing more from those that left than compared to how much you're gaining from those that stay. And that's all a function of this assumption right here, percentage increase in contract value at renewal. So we'll put that back down to 1% here. You see all the visuals will update. There you can see now churn's positive, meaning you're losing. Like that's bad if it's positive, good if it's negative, but it's really hard to make that negative. But this model allows for you to see what needs to happen in order for that to occur. Okay, so sales got into that gives you more insight on what's going on with the matrix tabs and kind of gives further validation to how the calculations are happening so you could trust what's happening. Sales, other costs. So this is pretty standard. You can pick the month that these, and I just broke it down into sales and marketing, general administrative costs, and research and development. You would put in these values based on what your business plan is proposing and when hires are happening, their monthly fully loaded salaries. Uh, and then that's just propagating through the P&Ls. You can see in this section, like here's all sales and marketing, which will only start when that month starts. You've got ad spend happening, which is derived from the revenue assumptions. You've got sales rep, which is from the sales tab. Um, we put customer service in the cost of goods sold here. But these are just all operating expenses that you're defining here. Also, I did a cost of goods sold where you might have to be paying some monthly fee um, per active customer for each tier. So you can define that here, and that's just going to do this fee times the number of customers at the end of the month, and that's that cost, and it's directly a cost of goods sold. If it's relevant, then you can put numbers in here. If not, then don't. Also, if there's like payment charges, like for people paying with credit cards, credit card fees, you can put percentages in here for that in the month start. Um, Usually it'll just be credit card fees, but I'd put in up to, what do we got here, 5 variable monthly revenue, or 5 possible slots for whatever you might have. Uh, One-time startup costs. These would be costs that are not, happen before the business actually starts. It will affect cash flow. Then you have capex, which I'm just defining capex here, future one-time expenditures on things. You might have this might result in depreciation, which we're not dealing with here. Usually in SaaS businesses, uh, it's not. I mean, it could be a big deal. It depends on how your SaaS is structured, but at least as far as calculating cash flow, it's important to be able to model one-time future expenditures whenever they might be happening. So based on all of those assumptions, we have our 5-year forecast, which is, you can see all the breakdown of the customers. You can also, in it, shows how much revenue, average revenue per customer, your cost of goods sold, your gross profit, other costs, which is all we went over with the general operating costs. Then also, if you ended up putting in that you're getting a bank loan, the debt service for that will automatically populate. The debt balance, if you put in an exit month, then it will pay off, you know, assuming there's enough cash from the proceeds, it'll pay off that debt automatically when calculating the cash flow for that month. Um, Here's the capex structure, the one startup costs, um, proceeds from the business, which is just a percentage of the trailing 12-month revenue if you've turned on exit. In this right now, I put an NA, but you see if I put it a month in there, you'll see it pop into the relevant month. Cash flow before taxes. Taxes. Now for taxes, I'm not auto calculating because there's so many variables that could affect taxes and different ways to do it. And I'm not a CPA and I don't really like to get into taxes. But what you can do on the annual P&L tab, there's a row here that allows an input for expected taxes for the year, and then that will flow to cash flow. And that's about as far as I really like to go with taxes on any of these kind of models. Um, then you got running cash position, and then we've got key metrics here. So customer acquisition cost, average monthly value per account, months to pay back customer acquisition cost, your churn in percentage of customers, churn in dollars, average life of a customer. Now this was actually really difficult to calculate with all the different contract lengths and trying to figure out how to average it best. I ended up taking a weighted average and I weighted it based on the revenue of each tier and then based on the retention rate at the given month, which would change, can possibly change each year. Based on the average contract length, I could calculate an average life and then apply that to the monthly revenue per account to get to a average lifetime value for the entire all 3 customer tiers. And then based on that, you can also do a ratio that shows what's the lifetime value relative to the customer acquisition cost, which is an important ratio. Higher the better. So we've got all the major metrics here. We've got the ability to derive a forecast based on customers that have different contract lengths, which you can define literally any length from. It could be 1 month to 60 months. But 1 month would mean, it's month to month, which a lot of, like, let's say Netflix or Sling or something like that would be month to month. But for the reason why I wanted it variable and to have up to like 10 months, 18 months, 24 months, whatever, whatever your situation calls for, is that logic doesn't get into models as that is a need that a lot of managers need to see um, to do financial forecasts. So I feel like this is done it the right way um, in order to see those numbers and play with them. We've got an executive summary tab here, which is just showing your high level, revenue, gross profit, expenses, EBITDA, debt service coverage, other cash items, cash flow after equity, and then you can see some charts here. I also pulled from the distribution tab. You've got internal rate of return for the project, equity return, cash returned, or equity required, cash returned, your equity multiple, projected ROI of the whole project. And then I've also broken down all those metrics for the investor and the owner if applicable. And then on the distributions tab, this is where your discounted cash flow analysis comes in. So we've got one for the project itself, showing the net present value um, based on the cash required up front and the present value of all the future cash flows. Also, there's a discounted cash flow analysis for the investor and the owner. There's also a check here, which will always be true. The only time this won't be true is if for whatever reason in a control you put in more proceeds than is required by equity, which you should never do. If you want to plan to have a buffer on top of your minimum cash requirements based on all your assumptions, if you want like a reserve, you just go to other costs, and in the one-time startup cost, just put in a number like $1 million or 2 million or 500,000, whatever the case is, and then that will reflect back in all the logic and reflect in your equity requirements. So you shouldn't ever have investor proceeds and or debt that equal more than the actual minimum cash requirement, which is just based on your monthly cash flow. The lowest point that gets to cumulatively would be the cash that is needed, which pops in here. And you see that's just negative min value of row 278 in the monthly P&L. Got a visual here for cash distributions of investor versus owner. And again, you don't have to have investors. You could zero that out and it'll just all go to the owner side. Or if you want to think of the owners as the only investors, you could just have that, assign them 100% and zero to the owners. And then you just have to make sure you've covered all the cash requirements. In this case, obviously, you'd have to put in another 6 point, oh, some number to make this zero. Here it's about 6.5 million. You can see if you did that in distributions, the owner here would just be zeroed out, and you can just see stuff for the investors, or vice versa. If you just want to put no investors but and no debt, but just have owner equity, that's completely fine. Debt matrix, this is just amortization schedule. You could put in the terms if you are taking out like a bank loan, um, interest rate, the term. The amount will automatically pull from the control tab. Okay, so I feel like this is really, of the SaaS models I've done, this is pretty high up there, and it's a unique value to managers that are trying to forecast this. So what I'm actually doing is creating an entirely new pricing tier that this will fit in. So I'm going to list it at eFinancial Models and Eloquent, as well as my own site, obviously. And it's going to be, so you can see on my financial models, I've done over about what, 86, 7, 90, 105. This is actually going to be listed. So I've got mid-level, intermediate, upper tier. I'm actually going to call this ultra, and it's going to be its own pricing tier. The reason why, and what I kind of try to do the tiers at is the level of complexity, the value, and the amount of demand I think the template will have all factor into the pricing. And this one's actually going to be in its own class. And I think I'll go up to $175, a one-time fee for the template. Now that might change in the future. I don't know. I just have to see how it's received, and it'll just be dependent on the demand. I possibly could lower the price, but it's going to start at $175 an hour, or not hour, as a one-time fee. And if you want to purchase it, the description will be in the box below if you're on YouTube. And after purchase, I will send you the template. All right, that's all I got for you. I'll see you on the next one.